We are potentially in one of the biggest asset bubbles that we have ever seen, but nobody is talking about it. Everybody is talking about how the stock market is doing outstanding, how the S&P 500 is hitting all-time highs, but is it about to pop? And is there some potential issues underneath the hood when we take a peek at just how top heavy this stock market is? Now, if you take a look at it, the top 10% largest US stocks reflect 78% of the market cap. This exceeds the previous record set in the 1930s by 3 percentage points. That's not tiny. This also is above the peak of the dot-com bubble, which was a bubble at 74%. So by comparison, the 1980s at the top 10% was below 50%. So the top 10% or the top 10 stocks as percentage of the S&P 500 is also at a record of 41%. So you got to ask yourself, hey, are AI stocks driving a stock market tech bubble? Let's take a peek into the data and really look at it, as they're going to try to sell me, get me to sign up to all this crap here now, of course, when I'm live. But Oracle shares soar, bullish earnings stock. The stock market valuation becomes sharply elevated. Now, is this another tech bubble? Because the S&P 500 is hitting all-time highs. It's up 13% in 25, even though we have gold up like 45%. And the bubble talk is that there's no bubble yet. Well, a lot of people fear this bubble. And let's see why. Well, there's been a growing income gap that has made essentially the rich get richer and the poor get poorer. Now, this would make for just normal times, right? We wouldn't be talking necessarily about a potential bubble with times like this, but let's look at this. It's the highest income gap that we've ever seen. The lowest income earners hit a whopping 526% lower than the high income earners. That's the second highest reading in the last 5 years. And that gap keeps going and increasing. And since 21, the gap has widened by 98 percentage points. 98. And so in November 2020, the difference between the top 25 and the bottom 25% was at 480%. So that's in November, literally 5 years ago. And so this comes as recent hiring is slowed down. The jobs data is absolutely looking worse, as we're seeing 1 million jobs written down. But is the stock market frothiness just the new normal? That's what everybody's saying. Oh, it's not a bubble. This is just the new normal. Why is this the new normal? Well, because the model of the bubble implies a crash, right? It implies that the bubble is going to pop and these prices are unsustainable. But portfolios are growing, and you essentially buy just the Mag 7 and it'll go up. You'll be fine. But by a host of the measures, stocks are trading at levels that suggest the neighbors have already called the police and the cul-de-sac ranger is about to be broken up. It's the price to earning ratios echo the dot-com era. And if you look, NVIDIA, the top dog, the biggest stock by market cap. Well, this was back in August, but the weight had reached 8.2% of the biggest indice on the planet. I mean, look at that. That's absolutely huge. Now, this percentage doubled since the start of 24. I mean, it skyrocketed in flight. And this comes as the chip maker's value hit 4.4 trillion. So by comparison, the energy sector is down to 2.7%. So 3 times less. So the energy sector fell, but NVIDIA took off. So NVIDIA is making history, and we've, the entire energy sector, 25 stocks, makes up 2.7. So one company was just very, very top heavy. So when you take a step back and look at all of this, the potential downfalls is that we're just so concentrated that we have an easy point of failure. Nvidia CEO says something crazy. Tim Apple says something crazy. Those stocks fall dramatically because of, one flop, iPhone 17, whatever came out recently. They start exploding in your hands like Samsung did. Something catastrophic, okay? It's what I'm trying to line out. Something catastrophic happens, well, the entire stock market is going to crash because the S&P 10 compared to the S&P 490, that S&P 10 or the Mag 7, the S&P 7 is absolutely crushing the rest of the market. And so we're getting an absolutely big top heavy market. Although it looks positive, although people see the S&P 500 floating above 6,600 for multiple days. We've had a few down days in a row. Actually, we had a little bit of an up day today. But the fact that the Fed has been discussing the potential of not cutting interest rates, that's what's worrying people. Investors have priced in already 3 rate cuts. But let's see. Is the percentage going down? At 89.8% chance that we actually cut interest rates. And that would just be a 25 basis point cut. I think because all of these things are already priced in, the reality is that the stock market's not really going to move too much unless, like I said, keyword, unless we really see a more than a one cut. If we see more than these 3 cuts that they've anticipated, that's when you'll see the stock market. But is Powell prepared to do that? I mean, yesterday we came to you, we got to 98.5. Now we're at 98.1. So we're seeing the troubling signs of the stock market now as it stands. And then on top of it, we're starting to see the potential of this stock market just get extremely, extremely top heavy. This market weight of the top 10 is shocking. Now, we see, of course, other things happening in the market, but the other thing that we're seeing is that not only the tech sector and the top 10 stocks, we're seeing the technology firms borrowing at a rapid pace. The tech companies have raised 157 billion in the United States public bond market, the highest year to date. Of course, we've got, some companies like MSTR borrowing a ton of money to buy Bitcoin, and that's kind of the new wave. But the amount that we're seeing borrowing to buy, whatever, buybacks, this is up 65 billion year over year. Is this a healthy thing? Up 75% or 70%, excuse me, and 134% since 2023. So Oracle is leading that rush with 26 billion of publicly traded debt sold. Meanwhile, investment grade corporate bonds have fallen. And I mean, of course, if you guys have been following this channel, please hit that subscribe button. Help me get to 1K ASAP. But if you guys have been following this channel, I've been detailing this tech sector and how, with inflation still sitting at 2.7%, right? It's not under wraps just yet. So the August PCE came out with the preferred inflation reserve. It rose. So even though it hit expectations, it still went up, right? And so the core PCE inflation was at 2.9, in line with expectations of 2.9. And that PCE inflation is its highest since February of 2025. Yet the Fed will keep cutting interest rates. So that's showing a dramatic shift where initially Jerome Powell was worried about inflation, saying, hey, you know what? We're going to stay higher for longer. Now it seems he's realizes he's on his way out, right? Come May, there will be no Jerome Powell, and he will and whoever comes in next is going to lower interest rates to 0%. So honestly, I'm somewhat surprised that Jerome Powell is bending the knee and going to cut interest rates. And I wouldn't put it past him. There's about an 11% chance at this point that he doesn't cut interest rates come this next meeting. The data is showing you that we might not be ready to cut interest rates. And so if that's the case, we're going to have a major crash because they're already pricing in interest rate cuts. So unless the Fed moves the needle, which they've done that already. They've said, hey, you know what? Maybe we need to rethink that 3% or 2% target and make it a 3% target. Well, I think it's going to be very interesting. And, we're seeing the evolution of this tariff development. Everybody was talking about the taco trade at some point in time, right? Trump always chickens out was the acronym. Well, I mean, look at these tariffs that he's announced over the last, earlier today or yesterday, excuse me. 100% on pharmaceuticals, 50% kitchen cabinets, 50 on bathroom, 30% on furniture, 25 on heavy trucks. And he would cut interest rates to 2%. So it seems like there's some sort of trade war still going on here, right? But, these tariffs have been actually not as inflationary as everybody thinks. I think that, we're still just not under wraps. Everybody's saying, wanting to blame this high, PCE rate on tariffs. But reality is that we're not going to see those layover effects from that for months down the line. So we're going to continue to see, people pointing the finger at this, but I need you guys to point the finger at, the like and subscribe button here for you, boy. And make sure you're hitting that like Cheech and Chong, because it's going to be a very interesting time as we continue to, go along with, let's call it the stock market as it is, right? Because we are just very overweighted, very overinflated. And investors have started taking massive amounts of profits. Now, this is kind of normal towards the end of the year. Maybe they're looking for Christmas gifts, other things. Maybe they realize, hey, you know what? I'm not going to have as big of a tax bill as they initially thought. But the top 1%, the top 25%, that wealth gap, as I said, it's getting bigger and bigger. So these professional retail and hedge fund investors are selling. The top dogs have sold 3.8 billion in equities, and institutional investors sold 1.4 billion. So they keep on selling. These hedge funds, they know something. Wall Street and Main Street are cashing in gains because we've seen a very top heavy stock market, to say the very least. So I'm going to be detailing all of this and following this very closely. So make sure you guys are hitting that like and hitting the subscribe button with the bell notifications so you guys can join All Nighter Hider in the chat. Make sure you're smoking that like, and I'll catch you guys all tomorrow.